a great day today. Obviously, yesterday we had some great speakers. Everybody enjoy yesterday? All right. So we always aim to, whether it's a up market or a down market, sideways market, we always aim to get the best people in the industry. And I think having been doing this now for 5 years, very humbled that the top names in the industry, you know, up markets and down markets will come and support CoinAgenda. And, you know, I think that of all the big names, I think we've probably had almost everybody speak at least once. Marco, I think this is his second or third time. I remember in the early days, I think it might have been the first or the third, we ended up having a panel because guess what? Even back in 2014 and 2016, there was like a lack of clarity going on about what you had to do. And it just seems like what's old is new again. But what's old is new again is different with Marco because he's now on the inside and not just doing law, but we're going to get to that. So first I want to introduce your moderator for the day. First of all, thank you, Jen, for doing a great MC job. And Pamela, you want to come up and say a little bit about yourself?
Good morning. Wow. I got to really raise this, don't I?
You do.
Good morning. Vegas voice. You're going to have to hear this voice all day. Sorry, but not that sorry. My name is Pamela Day. I'm the CEO of Paladin Trust. We're a digital asset custodian shop. The very unique structure. We blend together cold storage vaults with an OTC and trading desk, easily accessible, and a very unique tax structure as well, which allows for us to peg actual asset values and client asset values to the dollar, which hedges against downside. So Paladin Trust spends a lot of time with the types of folks we're going to be talking to today. If you've noticed, your agenda is a lot about securities, security tokens, and really investments. And so we're starting to see the progression of blockchain from the building of the networks and the building of that basic infrastructure now to the applications that get us into the financial markets and the financial world. And when you're talking about financial markets and the financial world, the next thing that goes hand in hand with is security and safety. I'm pretty sure everybody in this room has had some sort of a hack at some point. I won't even say the word, I know. That's just part and parcel with a growing, burgeoning new technology. But we're now getting to that point as we talk about securities. It's right there baked into the word, security. So we're going to talk a lot about that. We're going to talk a lot about investments, and we're going to talk a lot about how we're getting there right now, how this technology is getting us into the financial markets, and how that's transforming our lives. But to get us there first, we're going to spend a little time with Marco. Is he here yet? He is. Okay. So, and I'll let you introduce him, but his background is obviously exceptional, and understanding where the law is going right now, understanding the nuances of how we got to where we are, but more importantly, where we're going in the law is also going to help direct that conversation about the securities and the financial components that we're going to talk about today.
Thank you, Pamela. So when I first got into this industry in early 2013, you couldn't go more than three or four sentences into a conversation without the name Marco Santori coming up. So I quickly learned that there were basically, you know, at the time, two firms that everybody used. One was Perkins Coie, and of course we had Joseph, who heads up their blockchain practice, as a partner yesterday, and wherever Marco Santori was working. At first it was his own shop, then he went to Pillsbury, and all the business followed him, and then he went to Cooley, and all the business followed him. And now he's on the corporate side, and we're going to learn a little bit about, I don't think he's a recovering lawyer because he still has chief legal officer in the title, but I think at least I'm hoping he gets more sleep. And every time I've ever been on the road with him, including we had a trip to Andorra, of all places, phone, and I guess that's just, I mean, I think I'm busy with all the, calls I get for advisory and PR and strategy and all that. But boy, legal is just of the moment and changes every 5 minutes. And now he's president of blockchain.com, which is one of the early pioneers. And so we're going to talk a little bit about all of these things, get an update from Marco, who has not been on the speaking circuit quite as much as he was in the early days. And we're honored and delighted to have him. Marco, can you come up? So I see, oops, is it working? Hello, hello. So I see in the new startup life of sorts, only well-funded, you replaced the suits with the beard and the tennis shoes, so you're able to be a little bit. You look way more relaxed than any time I've known you in the past.
Thank
but let's go back to the early days. I think the first time, even though I heard your name a million times, I think the first time we actually had a meeting was. When we were looking for a legal representation for the first ICO, which was Mastercoin. And
that sounds right.
Yeah,
wow, Mastercoin.
Mastercoin. We had a meeting at, I believe it was Inside Bitcoins right here in Las Vegas at the MGM 5 years ago. And I think also Dan Larimer was there too, because he was just starting to out BitShare. So that was, and I remember the discussion being, we've gone into Bitcoin 2.0.
You know what? I think that you can track the progression of technology in this industry by the progression of language. And we used to call these things, like first it was Bitcoin, and the price is the least interesting thing about Bitcoin. And Bitcoin, it was Bitcoin, Bitcoin, Bitcoin. And then we started talking about Bitcoin 2.0, which are these like non-currency uses of the Bitcoin blockchain. And now nobody talks about Bitcoin 2.0, right? We'll talk about blockchain technology or DLT or whatever it might be.
And of course, the unfortunately named ICO.
Yeah, absolutely.
We still haven't figured out who to blame. Jim Blasco, who was on the panel yesterday, said that he threw it out in the chat room in Poloniex, and he may be the first to have used it, but I think it was like who invented television. There were a lot of people that came up with sort of like the cute name for it. I honestly think if they called it a token starter and just said it's a Kickstarter, it would have probably gotten a lot less scrutiny.
It's more like who invented the fidget spinner. Like that guy doesn't get credit; he gets something else. Yeah.
So let's just sort of take a little history tour of before you got to where you are today, and we'll talk about blockchain.com. So explain us a little bit of the evolution as you see it in the way that the legal industry in the United States has had to sort of like read the tea leaves of regulators. It seems in particular that FinCEN and SEC are much more opaque than CTFC, who's been pretty straightforward on things.
Yeah, so if you look at the history of crypto regulation in 2013 and 2014, the entire conversation really was around money transmitter laws and do I need a money transmitter license? Do I have to do KYC? Does the Bank Secrecy Act apply to me? That kind of thing. And it's mostly disappeared from the public discourse now. Certainly over the last year or two, people have been focused on an entirely separate set of laws, which are of course the securities laws. And the securities laws have been, they've dominated the conversation, not only because the questions are so interesting, because we have to, once again, reconsider first principles of investor protection, but also because the SEC is actually a powerful enforcement agency. And they're used to doing large-scale, high-volume enforcements, which is actually not how FinCEN has traditionally operated. Like FinCEN will be involved in a lot of different investigations because they're the big data arm of the government in terms of financial services. But they don't, go out and they don't have one enforcement action after another, and they don't have a Twitter feed where they announce their enforcement actions on the daily. SEC does. SEC does, and they're used to this kind of thing. So whereas the questions might be difficult, they're going about addressing them in the same way they have since the 1930s, which is, compared to a lot of different federal agencies, rather aggressively. And the CFTC that you mentioned is, of course, headed up today by Chris Giancarlo, who is I think, a champion of many in this room, and rightfully so. He's looked at the way that these laws work, and what's his nickname? Crypto Grandpa or something?
Crypto Dad.
Crypto Dad, right. Right, because he says, oh, my kids are using this stuff, and it's incredible, and we should have,
They're hodling. He used the...
yeah, they're hodling. And so, you look at the CFTC, that's kind of a niche regulator in a lot of ways, only has so much jurisdiction here. So they can be influential, and they can make sure that they broadly circumscribe their territory.
And a point that I've heard Chris make a few times is that they don't go and inspect the pork bellies. That's the USDA's. They don't look at each commodity. They basically want to make sure there's fair markets.
Right.
And with the SEC, they really do look at every security has to go through certain exemptions or registrations. And I think in some cases, some of the enforcements is where they just simply got the terminology wrong and said, hey, we're SEC approved. No, you're exempt. You're gone.
Yeah, well, I got to tell you, so we've seen a lot of people, I personally have seen a lot of people go both ways, and some people will just be engaged in a very long-term but honest mistake of not appropriately labeling their offering. Others, there's no mistake. They know what they're doing, and so that's the SEC's job, is dealing with a lot of really bad actors, and also sort of foot faults that are breaking the law, and they have to be enforced as well. I've done a lot of work with the SEC. I've always taken a consultative approach with them as to the projects that I've been involved with, and I think by and large they're doing the best they can, and I think they're doing well.
So the area that I think they're not doing well, and I've spoken about this a lot, is just simply clarity. And I think Manny talked about it earlier. The group that went to the 15 congressmen who then wrote him and said, we're not giving you a deadline, but you really do need to have some clarity on what regulations might be. You can't just govern by enforcement actions alone. And I've used the sort of analogy of it would be like having the FHA saying, well, we might repossess your house if you don't do well. If we don't, we're not going to tell you how long it's going to take to foreclose. We're not going to tell you anything about the interest rates, but but if you're wrong, we're going to take your house. That's kind of where we're at right now.
Well, I hear that, and I think that's one of the great that really is one of the great questions left unanswered. At what point is a utility token decentralized enough, right? Functionality is one component of that, but the way that the SEC is sort of informally engaged publicly has said, if the token is decentralized enough, then the thing is not a security. But when is it decentralized enough? What do we have? What are the standards? And maybe you've had a lawyer up here speaking about this already, but the best we have now is a heuristic. We don't have a test. We have this sort of collection of questions that you should ask, and one of them in particular is an important question, which is how many people actually hold your token, right? And that's something that we've been working on pretty hard at blockchain recently too, and I'm happy to talk about that.
And we will get to that in a second. I'm curious though about Clayton said we're not going to change the Howey test for crypto. It's fine the way it is. And yet, if you look at the Howey test, and I've studied this, I'm not a lawyer, but I feel like I'm playing one on TV a lot, right? And I've talked to somebody, I'm constantly trying to get the best and brightest advice from all the top folks. And there's not a consensus around interpretation between the different firms. Seems a lot of the Silicon Valley firms are like, well, Clayton said everything and it looks like a security. On the other hand, when he was sort of pushed on that, how many have you actually looked at? The ones that came to me for enforcement actions. Well, that's like saying, every black person I've ever met is a criminal because I've only looked in prison.
Yeah.
And so what I was going to say is the Howey test to me, let me play like dumb non-lawyer who knows enough to ask a question. Howey test the 4 points. I mean, none of them mention things like is it functional upon this or that? I mean, because otherwise a Kickstarter watch would be. That trades on eBay actively would be potentially that. I mean, it seems like that came because nobody's ever been issued an enforcement action to sell wine futures. They have the word wine, futures in them. You're giving them a consideration. They actually call them investment grade wines. You do have an expectation of profit. You buy Petrus and sit on it. It's going to go up in value every year. But that fourth peg about is the increase in value because of the active efforts of management or because of the increase of the value itself. Clearly with wine, you can have management be cleared out for fraud, and if the wine is liked by Robert Parker, it's going to go up in value.
Yeah. So I think that the important thing to remember when you find yourself swimming in all these different interpretations is that the SEC is not the arbiter of what is a security and what is not a security, right? The courts are that arbiter. And because the SEC is a plaintiff, the circle that they'll draw around things that they believe are securities is much broader than the things that the courts will draw around what they think are securities. So as a business person, you have to make a business decision as to whether you want to make precedent and you want to disagree with the SEC if you have to, and actually take some matter to court, or not. There is sort of an end run around this, and it's usually an involuntary end run around it, which is if you get sued by a private plaintiff. SEC has nothing to do with it, right? Right now, we have class action lawsuits against pre-functional token sellers, right? ICOs.
We have David Silver here tomorrow.
Oh, perfect. So he knows about some of this stuff. Although I think he just lost one with. Anyway, I'm sure he will tell you the war stories because we've all lost cases, litigators at least. So one way to have an end run around this is to get sued. And then a court will, in fact, adjudicate on the very same law as if the SEC was suing you. So if some private plaintiff sues you, like one of David Silver's clients, if he were to sue you, you'd find yourself in court, and the very first question the court would have to answer is, do the securities laws apply to this activity?
Was this Gigawatt? Did they finally do something on that? Or I have to look up to see which one he just lost.
Yeah, I won't mention any specific case, but the idea is that these questions are going to get determined by the courts. And I think they're probably going to get determined by the courts before they get determined by the SEC. And so, yes, a legal process can be long, but at the end of the day, SEC has no precedential power without like a rulemaking activity.
So what they end up doing, actually, what I'm seeing is they're going after the really easy ones, right? The ones where there's a clear violation. They made. Was that clapping my statement or his?
I'm clapping the fact is that they're attacking all the smallest guys that
Yeah.
can put out a business because they don't have the resources.
Right, exactly. So I think, and I know you're very close to this when it's Genesis. Oh, I was turning to Marco again. So I think that the first people to fight back may be Wyoming. Because right now there's this question, open question, about they were really clear. They said, hey, SEC's not doing anything. We're going to go, and I know you're intricately involved in this, and Caitlin is here later today to talk about it. But I think from a legal perspective, they are saying in Wyoming that, hey, we passed this thing 60 to nothing. The governor signed it, and we believe that if you go and keep your tokens in a Wyoming LLC, and they even made the Series LLC law at the same time, it's an intrastate offering. And so if the SEC or some Georgia SEC Securities Commission goes after it, I think Wyoming, they're cowboys. They're going to defend that.
Yeah, look, I mean, 10-gallon hats or not, the other states would have probably very little interest in going after that and very little claim to jurisdiction. The federal government would be able to claim jurisdiction in the sense that, well, we would be able to claim jurisdiction if one of the parties used any means of interstate commerce, which is a very broad term, but there are intrastate exemptions in the securities laws which would exempt them. So I think it's a question of enforcement appetite, and right now the SEC is I'll step back and I'll say historically over the last couple of years we've seen the SEC's enforcement appetite be satiated by plenty of bad actors to go after, right? Not just those who have principled objections to their interpretation of existing laws. Those are two very different camps of people from an enforcement perspective, but both viable defendants.
And a very good division. I remember back in the days of MasterCoin, I mean, we did the PR, Bit Angels pretty much did most of the funding, and for about a year, everybody's like, oh, MasterCoin, you're all going to jail. And of course, it's still around today, 5 years later, as Omni. But,
and of course, those violations are all civil, so literally no one's going to jail.
No, I think it was just the fact that they thought that it was a security or this or that or some other things before that was even brought up that much. So I'm going to switch quickly. One last legal thing. I suppose it's fair to kind of call you the father or the godfather of the SAFT.
Well, so the SAFT story doesn't start with me or my team. It starts, I think, probably with Olaf Carlson-Wee on the West Coast, or someone else who saw a SAFE, a simple agreement for future equity, and hit Control F and replaced equity with tokens, and started using that, which was innovative and horrifying if you're a lawyer, right? But what we did, we saw that being used, and we saw it sort of happening in the Bay Area and the West Coast, and we saw that it could. We thought, there's actually something to this, using a securities instrument to bridge the gap between when a token is issued and when it becomes this sort of functioning commercial good. And so we put some more thinking into it, and we came up with the SAFT project framework, which was a joint effort between Cooley and a company called Protocol Labs, which launched Filecoin, something you're probably familiar with, and if you've worked in this space. And the SAFT framework is actually pretty straightforward. It says, look, in the early days of issuing a token, there's a lot of investment-like risks most of the time, and not speaking of any particular token, but what we've seen by and large is there's a purchaser who is relying on the efforts of the issuer to realize a profit in this common enterprise, and that, of course, is the Howey test. But that doesn't persist, right? After a little while, you've got something like Ethereum where the value is going to go up and down based on all kinds of crazy market events, and whatever reliance the purchaser has placed on the issuers, it's not really a question of them expending their technical and managerial expertise anymore. Now it's a question of, well, what's the market for distributed computing like?
So it's interesting that up until Clayton sort of issued his opinion on Ethereum was probably a security, but no longer is one, there was a lot of kind of anti-SAFT opinions saying, once a security, always a security. If you did a SAFT, you can't get on Bittrex or you can't get on utility exchanges. That seems to have gone away after that very simple statement. And now I'm hearing, because I used to talk to also Big Four accountants who basically were saying, if it's a security, pretty much the same thing. Or if you change it, then you have huge tax complications starting as a security and then ending up as a consumable. And now I'm actually hearing the opposite, where they say, well, it's great to start as security, and then when you convert it, you actually defer your tax obligations to pay the taxes. So 180-degree turn.
Yeah, well, I think that when people, this isn't like the pendulum swinging back, it's just people hearing about the SAFT framework and hearing grumblings and complaining from people who were doing pre-functional token sales. And what you're describing is the process of people actually reading what we wrote and starting to understand what we were saying. Like, in the SAFT framework, there is no transformation. There is no, a beautiful butterfly comes from the cocoon of the caterpillar. There's no transmogrification. There is a security that is sold to accredited investors or otherwise pursuant to an exemption under the securities laws. It's a piece of paper. It's not a token. And what that entitles you to is no different than what a stock, the dividends that a stock might entitle you to. The dividends aren't securities, but the stock is. Just like in the SAFT framework, when you sell a SAFT to an accredited investor, that SAFT is a security. It should be sold pursuant to an exemption in the securities laws to accredited investors. But once the token works, once you've taken in all that money and spent the time and the effort and expended your technical and managerial expertise, what comes out of it is not the SAFT. What comes out of it is a token that actually works. And so, the speech you're referring to on Ethereum was, of course, the famous Hinman speech at the Yahoo Finance conference, where Hinman did not give the SEC's position on this, but Hinman is the guy in the SEC who decides this stuff, gave his own personal opinion on this, and that own personal opinion was, well, Marco, what you said is this much of a bigger picture. So they didn't endorse the SAFT framework, but they said yes, in fact, a token, like a transaction can start off with a security and end up with a non-security, which was great. I certainly took an internal victory lap on that one. But he said there's more to it than that. You also shouldn't be selling the security, you shouldn't be selling the tokens in the context of a fundraising. So you shouldn't be marketing the thing like an investment. And he gave a whole bunch of different
Even if it's
factors.
functional.
Well, so that's the difference, and that's where the SAFT white paper stops, and SEC's sort of gloss around this begins. And you have to understand, practically speaking, if someone goes out and markets any contract as something that's going to get you rich quick based on my efforts, like there's not going to be a lot of analysis that SEC stops and goes. So they're going to say, look, that's a problem. We don't like seeing that. We protect investors. And if you're pitching something as a security or as an investment, I really don't care about the rest because that's my job. I'm here to protect investors. So like I said, there's the law, there's the core of what the law, and then there's the business decision of not to skate too close to the edge of the ice because that's where SEC lurks, even if it's not a question of like the law. So that's the dance that kind of occurs.
And again, I can go and tell you you're going to make money on wine, and it's not going to be security or a rental home or an antique. So we'll stop with that there, and we'll now move over to blockchain.com. So obviously, blockchain.com goes back to like the earliest days, 2011, I think it was started.
Yeah, 2011.
And it was sort of started along with BitPay, sort of as one company that Roger funded.
It was Coinbase. Yeah, Coinbase and blockchain were brothers and sisters in philosophy and business for a time, and then departed. And really, that's evident in the architecture that we've developed. Right, the Coinbases of the world have taken this custodial approach that looks a lot like Wall Street. It says you're an investor, you give me your money, I will hold on to it, I will act as your vault, your custodian, your bank, whatever it might be, and I will do things on your behalf. Blockchain has never done that. Blockchain believes in a user-controlled ecosystem such that you can self-custody, you can hold on to your crypto yourself. You don't have to ask us permission to spend your crypto because we don't have it. We give you software that empowers you as a user.
Is there a call back then? I don't know if it's still the slogan, be your own bank.
Yeah, it's our registered trademark, one of our proudest. One of our proudest. Be your own bank.
So when Vinny Lingham was here yesterday, and we had the fireside chat, and he said this in a few other times, but he really went into it at length in terms of just his analysis, which has been profoundly accurate over the years, about one thing that's sort of like keeping the price down right now and was predictable after the run-up was the burn rate of all these ICOs who raised in Ethereum and had to pay salaries in cash. In the old days, blockchain.info at the time solved that problem really simply. You worked for them, you got paid in Bitcoin. I'm assuming you're not getting paid in Bitcoin.
Well, actually we do. We do pay our employees in crypto, but we have the option of actually getting government currencies now. And so we keep a treasury of crypto, and we keep a treasury of US dollars and British pounds and euros and all the rest. So we have this is our philosophy around optionality, giving people the power to do those things. And so when I go to submit my expenses, I'll get those paid back in Bitcoin.
Awesome. And you know what? I think more ICOs need to give that option. They just don't think about it. They've got Ether, they've got Bitcoin, they've got programmers, they've got people who are getting into the space. It's just like, we'd like to pay you in Ethereum.
Yeah.
We'll even give you a bonus if you do or something like that.
Yeah, absolutely. I think that's right. And for what it's worth, it may be just a difference in culture. There's a lot of people that now are actually more interested in what crypto can do than rather just having crypto, right?
So with that in mind, your blockchain, not bitcoin.info, and is blockchain.com now, because it's a great URL. The expansion still seems like, I'm on your site several times a day, but it's to basically go and use the Explorer function because it's the best one out there. It's no longer like on the front page, so you have to kind of look a little bit, but that's fine. And I've noticed that a new thing that you've got, they're beautiful new site upgrades, by the way, looks like you're going to try to compete a little bit against CoinMarketCap.
Well, I wouldn't go that far. I think that we already have one of the most trafficked market pages in the world, right? And it shows all the data you want on the top 10 cryptos out there. So if you're looking for information on Augur Rep, you're not going to find it on our homepage. But if you're looking at the top 10, you're going to find it. You're going to find all the information you want. No, but one of the products that we actually have just released and just announced, we published our guiding principles for blockchain airdrops, which people have heard airdrops and it hasn't been very sexy. We think it actually can be very sexy. We think it can be incredibly transformative, not only for users who get free crypto, but also for issuers, for token creators, for token network builders. Right now, if you create a bigger and better Ethereum or the next Bitcoin, that's great, but it's not going to be great if only you have all the crypto, if you have all of it. So as you can tell, one of the themes of the last few years for my career has been figuring out alternatives to ICOs, because I didn't think they were going to last. One of those alternatives or additions can be an airdrop. So imagine you're a token creator. You've got the next Bitcoin. You want to get it out into the hands of millions of people. Well, you can use blockchain airdrops to get those tokens into the hands of 30 million wallets all around the world. We'll have 30 million by the end of the year if things progress this way. And what that does is allow people not only to get free money, but it also serves a curation and a discovery function for our users, so that if they came to the party for Bitcoin, but there's also something new and exotic here for them to try, they don't have to try to mine it. They don't have to try to buy it on an exchange. They don't have to participate in an ICO that may or may not deliver. They just get free crypto.
You do have to download a new wallet, though, if it's because it's not going to typically be. I mean, unless it's an ERC20 token. I mean, do you have restrictions about what types of tokens that you'll airdrop?
Yeah, and then so we published our guiding principles on blockchain airdrops just last week, and it gives a list of the things that we look at, the elements that we like to see in new token projects. And based on those guiding principles, we will decide which we expose our users to. So you don't have to download a new wallet. You do it right in the wallet. We've announced portions of our roadmap, and ERC20 support is absolutely on it.
How about smart drops, as David Johnson calls them?
What are smart drops?
So smart drops are basically, I call them bounty airdrops. It's basically where you're not just, you wake up one day and all of a sudden you got 2 widget coins in your ERC20 wallet, and you have no idea what it is and you never really care. Smart drop is what David's calls it. I've been calling them bounty airdrops. Is essentially you go and say, hey, like with Polymath, I'm an advisor there and an investor, and they said we want to go and connect for security tokens companies that want to issue a security token, as well as accredited investors. If you're an accredited investor, you can show this. We're going to give you, 100 or 200, I can't remember the number now, Poly tokens for filling out a form and basically signing up. And same thing if you're a company. They end up getting 50,000 accredited investors to sign up.
Yeah, and that's actually similar to the vision that we have. So you might know airdrops today as if you've got a private key to a network address, one day some coins show up there. That's not what we do, right? Because we don't control protocols, we don't control networks.
Yep.
What we do have is the attention of 30 million wallets all around the world and information about our users. The more information our users can provide to us, the more targeted, and we talk about this in our guiding principles paper, but the more targeted, the more information we have about those users, the more targeted your airdrop can be. So for example, if you're launching, this is now kind of hackneyed, but if you're launching a new Spotify that is built on crypto, for example, Audius or Tune, CHOON, is a good example of this, where there is a built-in cryptocurrency that powers a new decentralized Spotify. You can airdrop your coins just to music lovers, or Tune is kind of centered around electronic music. If you really like electronic music, you can get these particular tokens.
This is kind of almost an advanced form of the companies that go out there and say, hey, I need to get 1 million users for my new game. This is not blockchain, it's my mobile game.
Yeah.
And I'm willing to pay $2.50 for everybody who signs up, and they run ads and Facebook ads and all this stuff. Is it a little bit like that?
So if you can imagine the impetus for doing that, but supercharged by network effects. So by all of the network effects that come along with being financially incentivized. So with crypto, right, crypto lives and dies by network effects. If you've got one token, if one person has your crypto, it's not particularly useful. If 10 people have your crypto, it's not 10x more useful, it's much more useful than that. So if you can combine those two effects, you've got a kind of an idea of what an airdrop can do for your network if you are a network creator.
Do you have a price on this yet, or is it sort of varies?
Yeah, well, right now it's free.
Oh,
yeah,
that's great.
No, we don't charge listing fees or anything like that. What we will do is go through a comprehensive curation process, and well, we hope to get many right. We really hope to ensure that we are exposing our users to quality assets, but at the same time, and we write this in the guiding principles. You should go check it out on blockchain.com. But what we really want to do is get a few wrong, because if all we do is go out there and hit home runs, that means we didn't take enough swings. It means that we didn't push the envelope enough. We didn't take enough risks, and that's the whole point of this. Is we want to get crypto into the hands of people who will use crypto, but also we want to get new crypto into those people's hands.
So you're obviously not a fan of the statement, but only talking for myself, not for the SEC, member of the SEC, who said airdrops might be securities because it helps the company. And I'm thinking then the Pepsi challenge, if I give you a can of Pepsi to taste, that's a security.
It's a great question, and since people come here for the law, right, and not the airdrops, I will address it, and we do address it in depth in the Guiding Principles paper on our website. But so here's the thing: you've heard a securities offering is an offering even if it's for free, right? The free stock giveaway cases.
If it's stock, okay, go on.
But that's stock, right? The underlying thing you're giving away must already be a security. The airdrop cannot make it a security. The airdrop can do no harm in that sense. Otherwise, if you accuse somebody of of engaging in a securities offering because they did an airdrop of a non-security, and it's the airdrop that made it the securities offering, it's like arresting them for resisting arrest, right? If the underlying thing you're airdropping is a security, that's probably a securities offering, just like a free stock giveaway. But remember, in the Howey test, right, there's that very first requirement that there is an investment of money. With an airdrop, by definition, nobody invests money. And the cases here are actually uniform, that it requires some financial risk by the acquirer, by the purchaser. And that's not just like, the letter of the law and trying to find a loophole. There's a real difference there. The people who participate in an airdrop aren't taking on investment risk. They're just getting the thing for free. So again, this is sort of in the same theme as the SAFT project framework, that we want to try to eliminate investor risks where we can't control for them. That's what we see in airdrops. We can eliminate investor-like risks, and we don't have to control for them.
So we're a little bit over time, but I would be remiss if I didn't take one or two questions, if you have time, Marco. Sure. All the way on the end there. And
this question is from Michael and Marco both. So the question I have about airdrop securities, so we filed Reg A, it was accepted. We were told, no doubt about it, we couldn't do an airdrop. They said we couldn't do an airdrop because it was a contest of a security. And so we would have to go back and actually put together a contest that anybody could apply for, so that that we could offer an airdrop, but it would just be under the guise of a contest. What's your take on the position of the SEC that you can't do an airdrop? We're doing a security token, no doubt about it. Clearly a security token.
Yeah. Yeah, I mean, they're right. That this is a free stock giveaway, right? It is an offering, right? So if you are giving away a security and you are getting some value, the test is, quote, for value, and it's a very low bar. If you are doing the offering for value, right, then you are probably engaged in a securities offering. Now, I'm not your lawyer, and this is not legal advice, and you should rely on your own attorneys for this, and not the SEC, also, who is not your attorney. You should rely on your attorney. But in this context, yeah, I mean, they're right? This is the big T-Mobile case. They wanted to give away free stock, but there was no registration and statement in place for that particular issuance, for that particular giveaway. So, yeah, I mean, the securities laws apply. What most people talk about when they talk about airdrops is giveaways of things that would only be securities because they passed the Howey test, because they would be investment contracts. But we don't need to pass that test. We've already passed that test with what you're describing in just that 30 seconds. There's something that is already a security.
We have time for another question?
One more from Dennis.
Hi, Dennis O'Neill Capital Advisors. You know, the elephant in the room right now is that the fact is that obviously there's a lot of small companies that are, obviously scams or not run well or whatever the reason, but 90% of the resources of the SEC are going after subpoenaing all these small companies, which is putting them in a position to where that all their money, all their time, all their effort is defending these subpoenas, which is basically assassinating these small companies. And these larger companies that have larger institutional players that are part of them, they're better prepared to weather the storm. They're better prepared to hire high-end attorneys that the SEC doesn't necessarily want to go against. So for me, what's offensive, and I think that is really, really tipping the scales here, is that going for how do we justify the fact that the SEC is going for the most vulnerable companies, no matter, not based upon criteria, but just based upon their vulnerability, and how that the bigger companies, I mean, as we've seen in 2001 and 2008, we had $30 trillion market crashes, which nobody went to jail, nobody lost their job, because that the SEC was unwilling to fight against these high-profile law firms. So I guess the end question here is that why would anybody do an STO in the USA when they're regulating their policy and their guidance is strictly based upon subpoenas, not based upon giving any real guidance or policy? That wasn't too much. Sorry.
It's because the money's here.
Good answer.
So I'm going to ask the last question. Thank you so much for all this time and wisdom. So with security tokens, wasn't even talked about like a year and a half ago before Brock did the BCAP token. And then it seemed like, it's still, when science went out and like tried to raise, after incredibly successful incubator, and tried to raise it as a security token, it failed. They then turned around and just went to equity investors and said, how about giving us checks? And they raised $100 million.
Well, the thing.
So I would just like your opinion on security tokens and whether you see that, because blockchain.com, I'm assuming, is not getting into security tokens, whether you see that putting utility tokens out of business or whether it actually lifts all boats and everybody gets everywhere.
Absolutely not. Securities tokens are not going to put utility tokens out of business. They are two entirely different asset classes with two entirely different investor groups. The only similarity in terms of the Venn diagram for investors are folks who are just kind of comfortable with the underlying technology, right? The value of a utility token comes from things like network effects and functionality and demand for the token itself and the robustness of the platform and then everything else. Demand for a securities token comes from the very same thing that demand for a security comes from. The token aspect is just a question of whether you write it in an Excel spreadsheet or on Carta, if you're a startup, or you write it in a blockchain. Like that doesn't define the thing's value. So I think that securities tokens can be very powerful. And I think that the fact that there are investors who already understand the underlying architecture sort of in place will make securities token adoption work. But at the same time, like nobody's buying your securities token because they think they're going to 100x their investment, right?
Although if you bought, Amazon at $4 or you bought
Right.
Chipotle.
And you know what the difference is when you buy Amazon at $4, you get all of the protections of the Securities Act, all of the protections in the securities world. And when you buy a securities token, well, we're still trying to figure that part out.
Marcus Santori, thank you.